Recent SEC approval of in-kind redemption mechanisms for spot Bitcoin and Ethereum ETFs marks a landmark shift in liquidity architecture for institutional investors. This regulatory change aligns crypto ETFs with the operational mechanics of traditional asset classes, enabling direct token creation and redemptions. Institutional players are positioned to benefit from narrower spreads and reduced arbitrage costs. Early inflows into ETH ETFs exceeded $2.3 billion last week, highlighting strong demand from qualified buyers. Analysts view this as foundational infrastructure for the next growth phase in tokenized financial products. Dogecoin experienced significant institutional interest as whales accumulated over 130 million Doge within a 24-hour window, pushing prices toward key technical breakout levels. This wave of accumulation occurred while Doge price tested resistance near $0.25 after holding support around $0.22. Traders suggest that upcoming ETF announcements and renewed consumer interest in meme coins fueled speculative positioning. On-chain data shows whale wallet activity spiking near 48-hour highs. This highlights emerging structural flows even in retail-driven assets. In stark contrast, BONK tokens fell by approximately 14% as institutional selling accelerated, reversing earlier gains tied to speculative sentiment. Large holders triggered profit-taking after recent rallies caused oversupply at critical price zones. Technical indicators suggest BONK may test lower support levels if selling momentum continues. Analysts caution that altcoin asset classes remain prone to rapid sentiment shifts, even as Bitcoin and Ethereum hold relative strength. The divergence underscores the bifurcation within cryptocurrency segments. Coinbase sparked a new altcoin rally after adding 2 projects to its official listing roadmap, prompting sharp speculative buying across lesser-known tokens. The previews generated immediate price surges of 50 to 120% in anticipation of availability on the platform. Social sentiment and momentum-driven capital flows supported the rallies, even though fundamentals remain early stage. Analysts warn of heightened risk if actual listings are postponed or if liquidity fails to meet demand. Nonetheless, crypto markets continue responding strongly to centralized exchange signals.
Christie's International Real Estate unveiled a new crypto-only transactions division, providing high-end clients an avenue to purchase luxury properties with Bitcoin and Ethereum. The portfolio includes multi-million-dollar homes, such as Beverly Hills mansions and desert estates, transacted via on-chain billing processes. This move signals an emerging paradigm of asset pairing between crypto wealth and ultra-premium real estate. Real estate and blockchain analysts view this as integration of digital asset liquidity into physical asset ownership. Institutional enthusiasm for such infrastructure may expand rapidly across global markets. Equities saw mild retracement as investors prepared for a critical round of earnings reports and Fed commentary, leading to cautious positioning before major central bank decisions. Markets took a pause after several index milestones, reflecting profit-taking rather than panic-driven drawdowns. Treasury yields declined amid strong demand at debt auctions, while implied volatility metrics remain near neutral levels. Investor sentiment blends anticipation of hawkish tone from Fed leadership with trade uncertainty. Regional markets remain poised for directional shifts pending macro events. Consumer price inflation in June accelerated slightly, reinforcing expectations that the Federal Reserve will maintain current interest rates through year-end. The data triggered modest market shifts across equities, fixed income, and crypto markets alike. Inflation resilience coupled with robust labor conditions has muted expectations of rate cuts in the near term. Analysts note that cryptocurrency markets are sensitive to interest rate forward guidance, with implied rates now directly influencing volatility pricing. Markets continue to price for steady policy rather than aggressive easing scenarios. The IMF issued warnings over U.S. tariff strategy risks, suggesting prolonged escalation could pressure global growth. However, recent U.S.-EU tariff agreements provided some relief. Institutional investors are watching global GDP revisions and trade uncertainty closely. capital remains oriented toward sectors most exposed to cross-border supply disruptions. Buoyant corporate earnings from diversified multinational firms supported broader risk appetite. The IMS voice adds credibility to cautious optimism around deal stabilization.
Global crypto market capitalization declined by roughly 5.5% across major altcoin classes, even as Bitcoin and Ethereum held value more resiliently amid macro pressure and speculative rotations. This broad market drawdown reflects selective risk aversion rather than systemic stress. Bitcoin maintained support levels near $118,000, while Ethereum consolidated near $3,900 as ETF inflows balanced profit-taking. The divergence between blue-chip tokens versus meme-like assets highlights growing bifurcation in investor sentiment. Structural holders across major networks are providing steady demand. XRP futures volume on Kraken surpassed Solana for the first time, signaling a shift in interest toward more compliance-aligned altcoins amid ETF momentum. Institutional hedgers appear repositioning capital to tokens with clearer regulatory frameworks. ETH-based funds continue to dominate open interest metrics, but XRP's growing liquidity suggests new appetite. Analysts track this shift as a possible early indicator of speculative rotation toward regulatory positive assets. Futures flows now represent a critical lens for sentiment mapping. In token purchase strategy, Michael Saylor's firm deployed approximately $2.4 billion from its preferred stock issuance directly into Bitcoin, reinforcing treasury-focused capital deployment. This strategic allocation supports longer-term stability projections around BTC demand. Price reaction was muted, indicating pre-positioned capital versus reactive trading. Analysts highlight growing alignment between corporate funding sources and crypto treasury management. This development strengthens Bitcoin's perceived role as a corporate treasury instrument. Stablecoin market searches reached historic highs in recent hours as regulatory frameworks advance, especially around accountability for USD-based token issuance. Public interest and institutional activity now leverage stablecoin settlement platforms for cross-border transfers. The growth curve steepens with bank-led token initiatives and wallet integration into payment rails. As regulator clarity converges, stablecoins function closer to programmable liquid dollars. Investors treat licensed tokens like cash equivalents for working capital deployment. SoFi Technologies stock declined nearly 6% after revealing plans for a $1.5 billion common stock offering aimed at funding expansion. Despite bullish analyst commentary earlier in the day, dilution risk spooked investors in after-hours trading. Retail platforms are sensitive to dilution announcements even as growth investment continues. The stock fall reflects broader themes in fintech maturity and capital structure signaling. This event underscores the importance of corporate finance visibility in speculative sectors. SoFi investor optimism remains tied to its evolving, disruptive digital bank model, which gained attention earlier for spiking retail chatter by nearly 380% following bullish analyst coverage. That surge prompted high-frequency trading volume spikes on social platforms. Retail sentiment swings appear more short-term than foundational, though fintech narratives may attract capital if execution matches expectation. Strategic communication now plays a critical role in maintaining investor confidence across digital-first financial firms. Analysts caution over-expectation mismatches in retail-driven valuations. Emerging markets currencies maintained neutral shifts as capital flows balanced macro risk and trade transitions. Investors note modest strength in Asian equity-linked currencies. Yen appreciation continued amid domestic rate adjustments, while the euro held steady versus USD. FX hedging interest increased among global equity managers amid upcoming trade deadlines. Currency volatility remains contained, signaling cautious but operative positioning across cross-border portfolios. Investors emphasized stability ahead of policy inflection points. Debt markets preserve composure as credit spreads remain flat and issuance continues unimpeded despite corporate treasury crypto activity. Bond issuance and demand trends suggest calm confidence rather than yield panic. CDS pricing across credit tiers posted minimal movement amid cyclical caution. Mortgage bond sector remains sensitive to consumer affordability, but price resilience holds in core urban areas. Fixed income reflects strategic realignment rather than systemic stress.
Venture capital continues cautious investment approaches in crypto infrastructure and fintech, favoring token security businesses, custody platforms, and compliant middleware over speculative dApps. Funding velocity slowed for early-stage ventures, while later-stage capital flows remain active if governance frameworks are robust. VC firms prioritize regulatory alignment and enterprise utility. Blockchain firms building B2B services attract institutional attention. This shift reinforces maturation of digital financial ecosystem. NFT volume rebounded modestly, with CryptoPunk's floor prices rising above $200K after prior pullbacks, reflecting resurgent collector and institutional interest. Ethereum's strength underpins liquidity across NFT lending, gaming, and metaverse holdings. On-chain lending protocols reported normalized utilization rates, not speculative spikes. Analysts interpret this as ecosystem stabilization rather than speculative fever. NFT valuation models now reflect macro-regulated asset integration. Institutional positioning metrics reflect Bitcoin support near $118,000 and Ethereum readiness to test $4,000 resistance if inflows continue. Market signals suggest risk-adjusted entries into blue-chip tokens with structured hedges over speculative exposure. Volatility indicators remain moderate as option flows balance directional hedging with income strategies. Analysts emphasize importance of decentralized asset allocation visibility and stablecoin strategy coordination. This environment favors disciplined growth posture over reactive allocation. In summary, today's market activity reflects a convergence of critical developments. SEC infrastructure changes in ETFs, institutional accumulation in stablecoins and tokens, real estate asset tokenization, and retail-driven meme dynamics. As macro drivers stabilize in advance of central bank guidance and GDP updates, investor capital is recalibrating towards strategic layers in crypto and equity markets. Institutional flows anchor major tokens and alternative asset experiments, while retail trading remains selective and speculative. Strategic allocation based on policy neutrality, compliance frameworks, and token infrastructure resilience offers opportunity gearing into next phase cycles.